Okay, so this is module 25, banking and money creation. This is really where the meat of the unit starts. I don't want to, totally dismiss the what money is, types of money, M1, M2. Though we'll talk about M1 for sure. I don't want to dismiss time value of money, right? But those are, a little part of it. This is really the meat of the unit. Okay, so it's really important that you understand what's going on here. So, the monetary role of banks. So, a business's T account summarizes its financial position. It lets us know how well the business is doing. And so, we can look at this single table and look at what the business has on hand, what the business owes, and look at the general health of this business. In this case, it's Jim's Jerseys. And so, he owns $50,000 worth of equipment. This is equipment that he's bought, that he owns, that he's paid for, and he has $10,000 in cloth. These are his assets. He owns them. He can do whatever he wants. He can sell his equipment, he can sell his cloth, or he can turn those into jerseys or whatever. And then on the other side, he has $25,000 in liabilities. This is a loan that he took out from a bank. This is a liability because it is not his. He owes it to somebody else, namely the bank. Okay, and we'll get into T accounts a little bit, but for some of you, I think maybe visualizing the transactions that we talk about in a T account might make things a little bit easier. And in fact, last year's FRQ had a T account on it, so it's definitely something that you should be familiar with. Continuing with the monetary roles of banks. So here we have a simple bank balance sheet. Obviously, a T account. Obviously, banks are much more complicated than this. And we'll talk about in a minute. Banks oftentimes need to have more assets than liabilities. But here you can see Main Street Bank, and they're holding 10% of their deposits on reserve. They have $2 million worth of deposits, and they're holding aside as excess reserves $200,000. And the rest of their deposits, they have loaned out $1.8 million. And so you can see both sides add up, it balances out. The ratio of reserves to deposits is called the reserve ratio. This is something we will be talking a lot about. This is set by the Federal Reserve, and they can raise it or lower it depending on how much money they want in the economy. And the reason the Federal Reserve wants banks to hold some of their loans aside, some of their deposits aside, and not loan everything out is because there is always the slight risk of a bank run. This is not something we worry a lot about these days, but in the time of the Great Depression, before regulation stepped in, this was something that was a big cause of the Depression. So the problem of bank runs. What a bank run is if everybody wants to go to the bank at the same time and get their money out. Okay? This is going to cause a problem because, as you saw a minute ago, banks don't have all that money on hand. And now the banks only keep a small amount of the deposits. And what happens is if word spreads that people are trying to get their money out and they can't, all of a sudden everybody starts to do this, and this has a ripple effect throughout the economy. We'll see in a minute why this is not so much of a problem today, but the Fed still does this just to make sure banks have cash on hand for their customers that want it at any particular time. So let's look at some of the tools of bank regulation. First, we have deposit insurance, the FDIC. Any bank that you walk into, you will see a sign, or you should see a sign, that says FDIC. And this is a guarantee of up to $250,000 per account that you will get your money. So if you go to your bank and they don't have it at that moment, there's no need to panic because the FDIC ensures that your money is yours still and you will get it at some point. And this is one of the main reasons we don't really worry about bank runs today, is because everyone knows that the government kind of has their back. The next are capital requirements. In order for banks to not take excessive risks, they want banks to hold more assets than the value of their deposits. One of the big things that got us into the Great Recession were banks were making really, really risky bets with their customers' money. And when those bets didn't pan out, they had no way to pay them off. And so the Fed asks banks to keep more capital on hand, whether it's assets, whether it maybe is property, whether it's, I don't know, it could be art, I guess, in some cases, valuable art, or it could be cash, but they need to have more assets than they have liabilities. The next are reserve requirements. This is one of the major tools that the Fed uses. We'll talk more about this as we get into monetary policy, but they establish the reserve ratio for banks. And this makes sure that there's always a percentage of deposits on hand at any one time for the banks to be able to give out should their customers want it. And then finally, the discount window. This is the place, it's not a literal place, but this is where banks can go to the Federal Reserve and borrow money from them. If they're ever not able to meet their requirements, they can go to the Federal Reserve, borrow money, and they can meet the requirements. This is, again, another tool to make sure people are going to always be able to get their money. So now let's look at how banks create money. As we go through this should sound relatively familiar to you because the mechanics are very, very similar to the multiplier. So kind of keep this in the back of your mind as I sort of explain this. So we have someone named Eli, and he has $5,000 worth of cash in his pocket, and he wants to go open a checking account. So he goes over to Main Street Bank, puts $5,000 in the bank. Now that bank has $5,000 worth of liabilities because that's not their money. They have to give it to Eli whenever he wants it. And they have $5,000 in cash reserves. They can do whatever they want with that money, okay? But there is a reserve requirement in this economy of 10%. So the bank must keep $500, which is 10% of his deposit, in reserve. And they want to be able to loan out $4,500. Okay, this is how banks make money. They want to loan out whatever they can because they charge interest. And so whenever that person pays back the money, they're able to make some profits on the interest rate. So Main Street Bank keeps $500 in reserve, and they loan out $4,500 to Max so he can buy some furniture at Melanie's Mega Mart. Okay, so let's see what happens here. Melanie, she banks at the First Bank of Sherman. So she gets that $4,500 from Max, right? Max bought $4,500 worth of furniture. She takes it and she puts it into her bank, right? What must her bank do? Well, they have $4,500 in reserve. They must keep 10% of that aside, and they can loan out the rest, $4,050. Okay? And this will continue to go on and on and on and on until all of that money is lent out. And so just with these initial two steps, an initial deposit of $5,000 will create $8,550 only after two loans. Okay? And so this is how banks create money, is they loan it out. Now again, loans aren't real money, right? But remember, M1 is not only cash, it's also checkable deposits. And so the fact that there's money in the bank, that counts as M1. And this will continue and continue and continue. Now, rather than going through the process step by step, we have something called the money multiplier. Okay, and so let's look at how the money multiplier works. So the key to this multiplication of money is that the banks have to hold 10% on reserves and that they lend the remaining 90% out. Okay, we'll talk about some limitations, but we're going to make the assumption that all of the excess money is lent out and all of the money is put back into the bank. This 90% is known as excess reserves. So excess reserves equals total reserves minus required reserves, okay? And we'll talk more about this, and you'll see it, and you'll see what those are as we go through examples. So the creation process started with that first $4,500 loan to Max. And so the formula for the money multiplier is 1 over the reserve ratio, right? RR. So the money multiplier is 1 over the reserve ratio. And so our money multiplier in this economy is, okay, 1 over 10%, which is 1 over 10, 1/10, which gives us 10. So the money multiplier is 10%. And this tells us for every dollar that's deposited, or for every dollar of excess reserves, $10 of money is going to be created. So the initial $4,500 of excess reserves would be multiplied by a factor of 10 to create $45,000 of new M1 money, okay? And this is how banks create money. It's important to understand when we talk about new money, that initial $5,000 deposit does not count, okay? Because where did that $5,000 come from if you think back? It was in his pocket. It was cash. That's already part of the M1 supply. So you can either take the initial deposit, multiply it by 10, and then if they ask you for the amount of new money created, take that initial deposit out, or figure out the excess reserves after that first deposit and multiply that by 10. And again, as we go through examples, you'll see how this works. Now, what happens in real life, or what are some potential pitfalls to this? Why wouldn't all that money be created? Well, there's two reasons. Okay, the first is that banks may decide to keep more than the required reserves on hand. If banks are feeling nervousness about the economy, they might say, okay, the reserve requirement's 10%, but we want to keep 15% on hand, in which case the money multiplier would be smaller in practice. Even though the official reserve requirement is 10%, it becomes effectively 15% if they hold more of it. And so less money would be created. The second reason is all the money loaned out may not be placed back into the banking system. You can see over here in our cartoon, right? Some people might decide to keep their money under their mattress, okay? And so it's not getting put back into the banking system. I might get money out and just hang on to it. In that case, the money multiplier might be smaller than initially anticipated. Okay, so again, we will do some examples tomorrow. Ask me questions, but this is an extremely important idea. Lots of questions about this, and in fact, you will be having a quiz, in-class quiz, based on the money multiplier and some monetary policy.